Hello and welcome to the SCI video series to support the Accounting Processes course. In this video, we're going to be looking at how companies manage the uncollectible accounts, also known as bad debt. Before we get into how to estimate and manage the bad debt, let's review how companies keep track of the amount owed to them by their customers. When a company extends credit to a client, they keep track of that in an account called Accounts Receivable. You may have learned a little bit about this in your Accounting 1 course. And here we're going to extend this a little bit further because instead of just looking at a general accounts receivable category, we're going to break this down into what are called subsidiary ledgers, where we look at the individual accounts for each particular person. Now, when a company decides to extend credit to their clients, they're doing this with the understanding that they're taking a risk that some of these accounts are going to become uncollectible. This is just a normal part of doing business, and in order to keep accurate books, a company wants to make sure that they're estimating how much of these accounts they think will be uncollectible. They will make these estimates based on their prior experience as well as their industry knowledge. Now, there are two methods used for writing off accounts that are determined to be uncollectible. The first is what is called the allowance method, and the second is the direct charge-off method. We're going to take a look at the allowance method first. The allowance method allows us to estimate what accounts or the amount of these accounts that we think are going to become uncollectible. We use what is called a valuation account, and in the textbook the name is Allowance for Doubtful Accounts. This is a contra asset account, which reduces the amount that accounts receivable shows on the balance sheet. Our goal here is to come up with a proper valuation for our overall AR, or what is called a net realizable value. So as we can see, what we're going to do is we're going to take our accounts receivable, which for Kathy's Kitchens here at the time is $46,400. We're going to estimate how much of that we think is uncollectible, and we're going to add that into an account called Allowance for Doubtful Accounts. So in this case, we've estimated that $1,900 is not going to become collectible. So on the balance sheet, this amount is going to be subtracted from accounts receivable. That's going to give us the $44,500 that is the net realizable value, or NRV, for our actual asset account, accounts receivable. So let's take a look at the relationship here then between accounts receivable and allowance for doubtful accounts. As you can see, it is a contra asset account, meaning it has a different debit and credit side than the account that it's related to. This account is where we're going to basically estimate how much we think was going to go bad. At the time that we make this estimate, we're also going to enter the amount into our uncollectible account expense. We're going to be taking the expense at the time we make this estimate. This is important to understand, that we're making the estimate and taking the expense at one period in time, and later, when we need to, we will write off individual AR accounts using the allowance for doubtful accounts. The journal entry that we're going to use to adjust these accounts is we're going to do a debit entry to uncollectible accounts expense for the amount that we estimated, and then increase the balance with a credit entry of allowance for doubtful accounts. So when we're using the allowance method, there are three ways that we can estimate the uncollectible accounts expense. In this video, we're going to cover the percentage of total accounts receivable. In subsequent videos, we're going to cover the aging of accounts receivable and the percentage of net credit sales. So let's look at how we estimate our percentage of total accounts receivable. What we're going to do is we're going to take a look at our history with regards to our balances and accounts receivable at the end of the year and the amount that was uncollectible for that particular year. Looking at 2013, we had roughly 5% that was uncollectible. For 2014 and 2015, we hovered around 4.8%. So what we're going to do is we're going to take the totals for these two categories, and it's going to allow us then to come up with an average. So for those 3 years, we had an average balance of $43,453 in accounts receivable and an average uncollectible amount of $2,156. Now we can do a little bit of math, and we can divide our average uncollectible accounts by our average accounts receivable to come up with a decimal number that we can convert into a percentage. If we round, we're looking at right around 5%. Now this amount then gives us the ability to estimate what we have for our 2016 accounts receivable, and using the 5% determine how much of that we think is going to be uncollectible. So for 2016, we have an estimate of $2,450 that we think will be uncollectible. Now what's important about this method is that $2,450 is what we consider the new ending balance for our allowance for doubtful accounts. Now what makes this a challenge for some people to learn in the beginning is remembering that that is the new balance. And what we have to figure out then is how much is currently in the account and what is the difference between that. That is what we are going to be adding to the adjusting entry. So for this situation, if we want a new balance of $2,450 and we have a $108 credit balance in the account, we've got to find the difference between those two. We're going to take the $2,450, subtract $108, and that's going to give us an amount of $2,342. That is going to be our credit entry into allowance for doubtful accounts and our debit entry into uncollectible accounts expense. So let's look at this through the T accounts and make sure that you understand how we came up with this particular amount. At the beginning of this process, we had $108 in our allowance for doubtful accounts. We know that we needed to get to a new balance of $2,450 based on our estimate. So if we want to find the difference between those two, we subtract $108 from the $2,450 to come up with $2,342. This then becomes the amount that we enter as a credit entry for allowance for doubtful accounts and a debit entry for uncollectible accounts expense. So in the journal, the adjusting entry is going to use the debit entry first for uncollectible accounts expense, and then followed up with the allowance for doubtful accounts credit entry. So this is how we get the amounts that we need for our estimate using the allowance method and the percentage of accounts receivable to determine this estimate. Now we have one more scenario to look at here. Let's assume that instead of having a credit balance in the account, we actually have a debit balance. Now the way that we would end up with a debit balance is if we had in the prior period written off more accounts than we had estimated for. So if we had estimated, say, $2,450 in the prior year, and we wrote off a total of $2,700, then we would be basically on the debit side. We will have used all of our estimate plus a little bit more. What that means then is if we're going to come up with our new estimate for this year, we've got to come to the new balance of $2,450. Now to get there, we need to not only add the full $2,450 that we estimated, but we've got to make up for the $250 on the debit side. So in this case, what we would do is take our $2,450 and add an additional $250 to that, so that our adjusting entry is going to be for $2,700. So in this case, we do the same exact process that we did for the credit entry account, the uncollectible accounts expense first, and then the allowance for doubtful accounts, but the amount now is for $2,700 to get us to that new balance again. Thank you for watching, and in the next video we're going to be covering how we determine the estimate using the aging method and the percentage of net credit sales. We'll see you there.